In this episode, we talk employee benefits and how you can use them to benefit your student loan journey. Let's get started. Are your student loan payments or loan balances a major obstacle in your financial life? Then tune in and let's escape student loan debt. Hello, I am Brenton Harrison of Escape Student Loan Debt, and welcome to the Escape Student Loan Debt podcast. It's been a couple of weeks since we last talked, and there have been some developments in your student loan journey that we covered a little bit in the last episode, but don't yet rise to the level of having like a summary episode. So what I thought we would do this week is talk about a topic that is really relevant for a lot of people who are in a season called open enrollment. Open enrollment, if you're not familiar, is the time of year where an employer goes to their employees and they say, here are the employee benefits that you have available to you. We want you to make your decisions during this open enrollment season for what you're going to utilize for the 12 months to come. If you actually pay attention to and make use of your employee benefits, they can really, really benefit your finances in a positive way. And this is definitely true when it comes to your federal student loans. And to open up this episode, we're going to start with a certain concept. And the concept is something called a pre-tax deduction. And a pre-tax deduction is something that you can use to put money towards something, an employee benefit, an investment, a vehicle that reduces the income on which you pay taxes. For example, let's say that you have $1,000 that you're due to be paid on your next paycheck, and just for conversation's sake, you're going to owe 20% on whatever portion of that check is taxable. So if we have $1,000 that's due to be taxed at 20%, we're talking about $200 in potential taxes. However, if you have a pre-tax deduction available to you and you first put $100 aside using that pre-tax deduction, you have taken the income on which you pay taxes from $1,000 down to $900. And now the 20% is going to be levied against the $900, meaning instead of $200 in taxes, you pay $180 in taxes. That's the first reason that a pre-tax deduction is valuable. The second reason, specific to federal student loans, that a pre-tax deduction is valuable is because it lowers something called your adjusted gross income. An adjusted gross income is a tax term where you take the total income that you earn in a given year, and there are certain deductions that you can use to reduce that total income. And after those deductions have been used, you arrive at your adjusted gross income. And if you have significant federal student loans, you need to know and understand adjusted gross income like the back of your hand, because no matter which income-driven repayment plan you choose, the payment you make each month is impacted by your adjusted gross income. Even for repayment assistance plan, the newly unveiled plan that should be available at some time in mid-2026 or later, the payment that you make is based on a percentage of your adjusted gross income. So no matter which payment plan you're looking at, if you can find a way to reduce your adjusted gross income, you can find a way to reduce your student loan payment. And that's why pre-tax employee benefits are extremely useful. And understanding that concept, let's go into the biggest and most consistent one that we see for employee benefits, the money that you put into your 401k or your 403b at your employer. We talk about this concept pre-tax first because there are two different types or two different structures of employee benefit plans. There are Roth accounts and there are traditional or pre-tax accounts. And this concept is important to understand if you are seeking to have your loans forgiven through IDR plans. What dictates a Roth or a pre-tax slash traditional plan is when you owe taxes. As an example, with a Roth plan, you don't pay taxes on the money that you take out in exchange for paying tax on the money when it's contributed. As an example, you have that same $1,000 that you're due to be paid, and you decide that you're going to put $100 into your Roth 401k. Well, because this is not a pre-tax plan, you're still going to pay taxes on that full $1,000. You are not getting the benefit of a pre-tax deduction. But that money grows and grows and grows. And let's say that in your retirement years, you decide to take out $10,000 from that Roth 401k. You do not owe tax on a dollar of those funds at the federal income level because the government is only going to tax you on one side of the equation. They either tax it going in or coming out, but not both. And with the Roth account, you pay taxes on the front end in exchange for not paying them in retirement. Now, a lot of people love and rave about Roth retirement plans, and they argue that it's the only way that you should put money aside because you get your taxes out the way and you don't have to worry about it in retirement. But if you're looking at it through the lens of a federal student loan borrower who's on an income-driven repayment plan, the goal is to reduce your adjusted gross income. And the more you reduce your adjusted gross income, the lower your student loan payment becomes. And the lower your student loan payment becomes, the less you have to pay towards your loans that were already due to be forgiven, which in many cases is the goal. Conversely, with the traditional or pre-tax plan, you're putting money aside that you don't pay taxes on now. You get the pre-tax deduction benefits. But when you take that money out in retirement, you have to pay taxes on what you take out as if it was earned. But if you're trying to get that loan payment down as low as possible while also being able to save for your own future, traditional or pre-tax is often the way to go if long-term loan forgiveness is the goal. Next up, we're going to talk about three employee benefits that I go on and on about all the time. And those are health savings accounts, flex spending accounts, and dependent flex spending accounts. We're going to tackle the two easier ones first, and those are flex spending accounts and dependent flex spending accounts. Flex spending account is something that you can use regardless of the health plan that you have at your employer. And it's something that you can use to put aside funds pre-tax that go towards things that cover your health. We'll put a link in the show notes to some of the possible uses for a flex spending account. A dependent flex spending account is a tool that you put aside for funds that are pre-tax that go towards paying for things for your dependents. And a dependent could be an elderly person or a child under the age of 13. It has various uses, and you can put a significant amount aside in these two plans, and any dollar that you put aside comes right off of your income before taxes are owed, which reduces your adjusted gross income and lowers your student loan payment. Now, those are more straightforward, but the more complex of the three is the tool where you're actually able to put aside the most money and has the most potential uses, and that's a health savings account. And to understand health savings accounts, you have to have some basic knowledge of just health insurance terminology. So let's break some of this down. The first term that I want you to know is the deductible. And the deductible is the amount that you have to pay towards your care before health insurance companies step in to help with the costs. As an example, you could have a $1,000 deductible. That means you have to pay $1,000 towards your care before you get to your co-insurance period. And coinsurance is a range of healthcare costs where when you're in this range, the health insurance provider is going to participate in your cost at a certain percentage. As an example, if you have a $1,000 deductible and an 80/20 coinsurance rate, you pay $1,000 in the first range of cost with no help, and everything from $1,000 to your out-of-pocket max is covered at a rate of 80% by the healthcare provider, with you being responsible for the remaining 20%. Now, your out of pocket max is the maximum amount that you have to pay towards your care before the health insurance company covers covered costs at 100%. So, if your out of pocket max in this scenario is $2,500, you have your $1,000 that you pay towards your deductible alone. You pay 20% of your costs until you have met your $2,500 out of pocket max, and everything from there beyond is covered at 100%. I tell you these terms first because conceptually you can understand that the more the health insurance company potentially has to pay, the bigger risk they have on the back end, the more they're going to charge you on the front end. So if you have a really low deductible and a really appealing co-insurance rate and a low out-of-pocket max, you're probably going to have a pretty expensive monthly cost for your health plan. But the higher your deductible, the lower your coinsurance rate, the higher your out-of-pocket max, the less you pay, and that would be what's called a high deductible health plan. You have a plan where you are responsible for more of your potential health costs. And a high deductible health plan, because you're responsible for more, has a lower payment. Well, that has a benefit in and of itself when you're talking about trying to juggle the things that you're trying to juggle in addition to your student loans. So a high deductible health plan for a healthy person with typically low health costs represents an opportunity to save some money. Although, if you're a person who doesn't have the best health or has to see certain specialists or has consistent out-of-pocket medications, it may be a risk that you don't want to take on because of the potential of you paying more on the back end. However, for those who choose to do high deductible health plans, they can be paired with another pre-tax benefit called a health savings account. A health savings account is a really, really multifaceted and potentially useful tool. The money you set aside in that HSA is pre-tax, just like the others that we just talked about. So it lowers that adjusted gross income, checks the first box. The second box is the money can be invested when it's not used, just like you invest funds in your 401k. And while before the age of 65, you have to use those HSA funds for actual health costs, after the age of 65, you can use HSA funds for whatever you want to, which makes them a pseudo secondary retirement account. That's the second check. The third check mark is that when you do use them for certified health expenses, you don't pay taxes when you take the funds out either, which means that you don't pay taxes when the money goes in, you don't pay taxes while it grows in the market, and you don't pay taxes when you take it out, which is why HSAs are what's called triple tax exempt. And all of these things, your HSA, your dependent FSA, your FSA, your 401k, your 403b, can be used to benefit you in some substantial ways when it comes to your student loan payment. As an example, we're going to bring up two different scenarios, one of which is a person who's applying for student loan payments under the old version of income-based repayment, the second of which being a person who's applying under the new repayment assistance plan. So let's look at an example of a family of two on the old version of IBR and see how using pre-tax employee benefits can benefit their student loan payment. We're going to start with assuming they're using no pre-tax deductions and that they have an adjusted gross income of $105,000 for the year. Under old IBR, they subtract 150% of the federal poverty level for a family of two, which is $21,150, and it gives them a discretionary income for the year of $73,275. Knowing that under this plan, you pay 15% of that number towards your loans each year, this leads to a payment of $915.94 per month. Now, let's instead assume that this couple decides that they're going to utilize their employee benefits, the pre-tax deductions that comes from tools like 401k contributions, flex spending account contributions, and the like, and they're able to reduce their adjusted gross income from $105,000 down to $95,000. Using that same formula, we take $95,000 minus 150% of the federal poverty level, and instead of paying $915 towards their loans each month, they pay $790.94, a savings of $125 a month. And just by using those pre-tax benefits at their disposal, they not only decrease the income on which they pay federal income taxes, they also save over $1,400 a year on their federal student loan payment. Now let's look at the potential savings from someone on the repayment assistance plan who's utilizing employee benefits. Repayment assistance plan is calculated very differently from other income-driven repayment plans in that instead of using tools like the federal poverty level, they look at ranges of your income and they charge you a percentage of your adjusted gross income based on how much you earn. Now, for people with adjusted gross incomes over $100,000, they pay 10% of that adjusted gross income. So in our example of a family of two with $105,000 of adjusted gross income, they pay 10% of that adjusted gross income towards their loans, which ends up being $875 per month. Now let's assume that just like the couple in our previous example, they decide to use their pre-tax employee benefits and they find a way to reduce that adjusted gross income from $105,000 down to $95,000. Well, not only does that reduce the amount of income that's going to be used in this calculation by $10,000, but under the rules of the repayment assistance plan, it also knocks them into a lower range when it comes to the percentage of that AGI that they're required to pay. So before, when they were at $105,000, they had to pay 10% of AGI. Now that they're in a different range, they not only reduce their income, but they now pay 9% of AGI, which means instead of $875 a month, they pay $712.50, a monthly savings of over $160.
You're listening to the Escape Student Loan Debt Podcast.
Subscribe now at escapestudentloandebt.com.
Welcome back.
Welcome back, and we're going to finish up with life insurance and disability insurance. And life insurance is an interesting topic when it comes to the impact of a death on federal student loans, because most people have a misunderstanding of what occurs with their federal student loans when they die. Federal student loans die with you. So if I have $1 million worth of federal student loans, that's not something that my family is going to have to deal with upon my death. And unlike the general forgiveness that comes with IDR plans, where yes, it's forgiven, but you're potentially responsible for taxes on that forgiveness, the discharge upon death of federal student loans does not have a taxable impact. So when you talk about life insurance, then you would think, okay, well, if they die with me, then there's no benefit, at least from a student loan perspective, of getting life insurance. And I would argue that that really depends on whether you or your spouse has life insurance and on whom you're getting the coverage. For example, let's say that I have a tremendous amount of federal student loans. Well, yes, my loans die with me, but heaven forbid something were to happen to my spouse, I would want to get life insurance on my spouse to potentially cover my student loan debt. So if I'm sitting in an open enrollment meeting and I am asked whether I want to apply for more life insurance, I'll tell you as a financial advisor, my preference is for you to have the overwhelming majority of your life insurance coverage outside of your employer. And I look at the plans that your employer offers as kind of icing on the cake because they're really cost effective. And because they're so cost effective, it would be an easy way to pick up enough coverage so that in the hopefully unlikely scenario that your spouse passes anytime soon, you would have enough from that workplace plan to cover your remaining student loans. And then lastly, disability insurance. Disability insurance is paycheck protection. The goal of a disability insurance plan, period, but specifically one at your job, is to put you in a position where if you are ill or unable to work for certain periods of time, that a percentage of your income is replaced. As an example, you'll find that a typical rate of replacement for a group plan is going to be 60% or 66.7%. So when people look at federal student loans, there's often several misconceptions there. The first is, oh, if I'm on disability at my job, then I won't have federal student loan payments. That's likely not true. When it comes to federal student loans, the only way to have them discharged due to disability is if you are totally and permanently disabled. And that's a higher bar than what makes you disabled from your job. Now, there is an element that says, hey, because I can't work, if my income is reduced, I would have a lower payment under income driven repayment plans. Even that depends on things like the income of your spouse. It also depends on what percentage of that disability insurance your employer was covering on the front end. And what that means is whatever percentage of your disability insurance your employer covers for you on the front end is treated as taxable income on the back end. I'll give you an example. Let's say we have a person who earns $50,000 and while they're working, they have a group disability policy and their employer covers 90% of the costs. Well, something happens down the line and this person who was making $50,000 becomes disabled from their job and they go on claim using their group disability policy and they find that their disability policy replaces 60% of their earnings. Well, that means that they immediately go from $50,000 of income down to $30,000 of income. But remember, their employer covered 90% of the cost of that policy. So while they're not working, and you would think that they wouldn't have to owe taxes on any of it and it wouldn't factor into their student loan payment, 90% of that $30,000 benefit will be considered taxable income, which in this case is $27,000. It will show up on a tax return, which means it shows up on adjusted gross income, which means it's considered in the calculation for income driven repayment plans. Now, if this person were single and the only thing they had on their tax return was $27,000, they would likely have no student loan payment. But if they're on disability and they're married and their spouse earns significant money, you would think that on disability, you at least wouldn't have to worry about any of your income being in the calculation for your payment. But in this scenario, 90% of those group disability benefits are going to be added into the pot for calculating what you pay on a monthly basis. Now, does this mean you don't get disability insurance? Absolutely not. It's actually the opposite. You would want to make sure that in the event of a disability, you have enough to cover your monthly expenses so you're not stuck with the double whammy of being broke and also still having a student loan payment. And when it comes to the shortfalls of group plans, there are several of which people are often unaware. One of them being the just flat out reduction in pay, where you could go from 100% to 60 or 66.7, but also the understanding that some of those benefits could be taxable, and also the fact that in most cases, overtime pay is not covered by disability insurance. Bonuses are often not covered by disability insurance. Equity compensation is not covered by group disability insurance. And also, any scenario where you're in sales and what you're earning as a bonus or commission is not considered part of your base compensation. So you need to have an understanding, a full understanding of your disability insurance and what you would get in the event that you are ill or unable to work, to make sure that you've positioned yourself so you're not out in the cold, either figuratively or literally, not just when it comes to your finances, but also when it comes to your ability to cover your student loan responsibilities. So that's a broad overview of the impact of some of your employee benefits on your federal student loans. Any topic that we've covered, like the FSA, the dependent FSA, there will be details in the show notes that give you an idea of the contribution limits or the uses that are potential options for these plans. If you have any questions about your student loans and you want to go through a review, you can obviously do that by going to escapestudentloan.com/session, which we'll link to in the show notes. That will give you access to a private student loan review with me. Or if you're interested in a complimentary consultation that would then be rebroadcast to our audience after you've been de-identified, you can go to escapestudentloandebt.com/review to apply for consideration. From Escape Student Loan Debt, this was the Escape Student Loan Debt Podcast, a show for established professionals whose student loan payments or loan balances are impacting their marriage, their business, their credit, or their dream of achieving homeownership.